So I want to start off the discussion of Chapter 7 with just a basic review of accounts receivable. These are things that I don't want to have to address in class or in the other lectures. And this is sort of separate so that if you need a short brush up on accounts receivable, you can watch this. Otherwise, you can skip it. So we have five essentially transactions that we want to record that, more or less you should be familiar with from your intro class. In order to make a sale on credit, we make the following journal entry, right? Accounts receivable and revenue. We've provided the goods or services, therefore we can record the revenue associated with accounts receivable. This, of course, increases an asset and also increases net income. In order to collect on these accounts, we have to go to our customers and make our collections. Whenever we make a collection, this is just a debit to cash and a credit to accounts receivable. People are pretty familiar with these two. Asset for an asset transition, both of them are current. Nothing really new here. So what arises then, which starts becoming problematic typically for students, is that because we are opening ourselves to credit sales, we're also providing ourselves with extra revenue that these credit sales will generate. The extra revenue, of course, comes at a price. And as you know, any price or any cost that we incur along with additional revenues has to be matched to these revenues. Now, I will talk about the estimation techniques for bad debt expense and adjusting the allowance for doubtful accounts. However, the basic journal entry should be familiar to you. This decreases net income by the bad debt expense. The credit to allowance for doubtful accounts is a decrease to our assets. Remember, the allowance for doubtful accounts is a contra asset account. I'll shorthand it ADA. Since it's a contra asset account, it is increased by credits, decreased by debits. And remember, this account reduces accounts receivable on the balance sheet. Remember, we show receivables at a net amount, and that amount is net any of the allowance or doubtfuls that we have as a balance in this account. Once we know a customer has defaulted, so this is when they actually default, right? This is just an estimate of default. This is not an actual event of default. But once we know that they're going to default, we would then reduce our estimate of defaults and credit the actual account receivable. Now, this again is where people start to get a little confused. You need to hammer down this idea. This reduction to allowance for doubtful accounts will increase our assets, but we turn around and then reduce our accounts. So what I think of this transaction as is removing an estimated doubtful and writing it off as reality. So you want to think of the allowance as your pool of estimated accounts that will go bad. These are not bad accounts in reality until we know they're going to go bad. When we know they're going to go bad, we remove them from our estimate and we remove them from our actual accounts receivable. If you notice, this write-off entry, it's called a write-off because we're actually writing off an account by crediting accounts receivable. This write-off entry does nothing to the net realizable value of receivables. The net realizable value is equal to the balance of AR less the balance of ADA. So if we remove $1 of receivables from ADA, we're subtracting less. So you would think it would increase the net realizable value, except as we remove $1 here, we also remove $1 here. So when we remove $1 in both what we subtract and what we add to find the net realizable value, we end up with no effect. So this entry has no effect on the NRV. Right? We're just moving something from an estimated bad debt to an actual bad debt. And I go into explain that in mathematical terms here. And then finally, if a customer we wrote off as defaulted, suddenly becomes able to pay us, we make a reinstatement entry, which means that we then credit the allowance for doubtful accounts and debit accounts receivable, effectively just reversing what we did here. So what we say is, all right, they didn't go bad on us, so someone else has to have gone bad by our estimate. So we add back their account to the bad debt estimates, the allowance for doubtful accounts, and then we debit the accounts receivable. Now the follow-up to this will typically be a collection. If they promise to pay, then we would have a collection on their account. So you can either have a reinstatement without collection or a reinstatement with collection. Typically in my problems, I just do a reinstatement with collection. And that way, what it really boils down to is a credit to the allowance for doubtful accounts and a debit to cash, because a debit and a credit both to AR for the same amount cancels itself out. Right? And again, when we actually have a reinstatement, think of it this way. If I picked out 3 of you from the class and said, all right, you're my 3 bad debts, and then I wrote one of you guys off, right? So there's 2 bad debts remaining in my allowance for doubtful accounts, and I wrote off one of you, so that person's no longer in my allowance for doubtful accounts. Well, if that one person I wrote off pays me back, then they weren't a bad debt. So I would want to increase my bad debts back up to 3 again, because if they weren't the bad debt, the idea is that I made an estimate of bad debts, and therefore someone else must be my estimated bad debt. Okay. So anyway, that is the basic entries for accounts receivable, and we will be looking at that much more in depth in Chapter 7.